Welcome back, traders. In today's video, we're going to explore one of the most powerful and exciting opportunities in the Forex market, trading gold, also known as XEU-USD. Now, gold is not just any commodity. It has been considered a symbol of wealth, security, and value for thousands of years. From ancient kingdoms to modern central banks, gold has always played a unique role in the global economy. And in today's world of Forex trading, it remains one of the most actively traded and profitable assets. But here's the thing, trading gold is not the same as trading EUR-USD, GBP-USD, or any other currency pair. Gold has its own behavior, its own triggers, and its own volatility. If you approach it like any other pair, chances are you'll get burned. But if you learn the secrets behind its movements, the right times to trade it, the strategies that work best, and, most importantly, how to manage risk, you can unlock consistent profits. So, in this video, I'm going to break down exactly how to trade gold in Forex trading step by step. We'll cover everything, why gold moves the way it does, which sessions and timeframes are best, the technical and fundamental tools you must master, the psychology and discipline required to handle its volatility, and the strategies that top traders actually use. Stay with me until the end because I promise you, if you want to make money trading gold, you need to hear every part of this. 1. Why gold moves, the fundamental drivers. The very first step in mastering gold trading is understanding what moves its price. Unlike many currency pairs, gold doesn't just respond to interest rates or GDP numbers. It reacts to a wide range of factors. Let's break them down. The US dollar relationship. Gold is priced in US dollars across the world. This means there's an inverse relationship between gold and the dollar. When the dollar is strong, gold usually falls. When the dollar weakens, gold tends to rise. Think of it this way, if you hold euros, yen, or pounds, and the dollar drops, gold becomes cheaper for you to buy. Demand increases, and price goes up. That's why you must always monitor the US dollar index, DXY, when trading gold. Be inflation and interest rates. Gold is considered a hedge against inflation. When inflation rises, investors look for assets that protect their wealth. Gold shines here because it holds value while currencies lose purchasing power. Interest rates also play a big role. When central banks, especially the Federal Reserve, raise interest rates, gold often falls. Why? Because higher interest rates make the dollar stronger, and they give investors alternative ways to earn yield, like bonds. When rates are cut, gold usually rises. See geopolitical events and risk sentiment. Wars, conflicts, political instability. These are fuel for gold. Why? Because investors flee risky assets and rush toward safe havens. Gold has always been that safe haven. Look at history. Every time there's uncertainty in the global economy, gold spikes. Central bank policies. Central banks hold tons of gold as reserves. When they start buying more, it pushes demand and price up. When they sell, pressure builds downward. Keeping track of central bank policies, especially from the US, Europe, and China, can give you an edge. So remember this: gold is not random. Its price moves with fundamentals: the dollar, interest rates, inflation, and global risk. Once you understand these drivers, you're already ahead of most traders. 2. Gold's volatility and choosing the right time frames. One of the things that makes gold so attractive is its volatility. But volatility is a double-edged sword. It creates big profit opportunities, but it also brings big risks. How volatile is gold? Gold can move 100 to 200 pips in a single day, sometimes within an hour during major news releases. Compare that with EUR-USD, which often moves only 30 to 50 pips in the same time frame. That's why gold is a favorite for day traders and scalpers. Best time frames for gold. Scalpers prefer the 5-minute or 15-minute charts because gold gives sharp, quick movements. Day traders find success in the 1-hour and 4-hour charts. These time frames filter out some noise but still provide plenty of action. Swing traders often use the daily chart. Gold trends strongly, so catching multi-day moves can be very profitable. Here's the golden rule: the shorter your time frame, the higher your risk. Always choose a time frame that matches your personality and risk tolerance. 3. Technical analysis tools for gold. Gold respects technical analysis beautifully, but only if you know the right tools. Let's go step by step. As support and resistance, gold loves psychological levels like a 1900 or 1950, a 2000 and 2050. These round numbers are magnets for traders and institutions. Always mark these zones on your chart. You'll be surprised how often price bounces from them. Both moving averages, 50 EMA and 200 EMA, these two moving averages are critical. When gold trades above the 50 EMA, the short-term trend is bullish. When it's below, it's bearish. The 200 EMA defines the long-term trend. A cross of the 50 EMA over the 200 EMA is called a golden cross, a strong bullish signal. The opposite is a death cross, signaling bearish pressure. See Fibonacci retracement. Gold respects Fibonacci levels almost perfectly. After a big move, use the Fib tool to find retracement levels like 38.2%, 50%, and 61.8%. These are common points where gold reverses or continues its trend. DRSI and MACD, the Relative Strength Index, RSI, helps spot overbought or oversold conditions. Anything above 70 signals a possible reversal down. Below 30 signals a possible bounce up. MACD is great for identifying momentum and trend strength. Use it to confirm your entries. Combine these tools, and you'll have a reliable technical framework to trade gold with confidence. 4. Best trading sessions for gold. Gold trades 20:45, but not all hours are equal. Here's when you should focus: a London session 6-7 a.m. 4 p.m. GMT. Huge volatility as European traders react to global news. New York session 12 p.m. 9 p.m. GMT. Explosive moves when U.S. data like CPI, NFP, or Fed announcements are released. London, New York overlap the single best period to trade gold. Liquidity and volatility are at their peak, and price action is very clear. If you're trading gold seriously, avoid the dead hours of the Asian session unless you're scalping small moves. The real money is made when London and New York overlap. 5. Risk management in gold trading. This is where most traders fail. They love the big moves in gold but forget the danger. Risk management is your shield. Lot sizes. Gold moves more aggressively than pairs like EUR/USD. If you normally trade one lot in Forex, consider 0.5 or even 0.2 in gold. Protect your account from oversized losses. Stop losses. Never trade gold without a stop loss. Place stops at logical technical levels, below support and buys, above resistance in sells. Don't widen your stop just because you hope the trade will come back. Risk per trade. Stick to 2% of your account balance. Gold can easily move against you by 120 per ounce in minutes. Without strict risk control, you could blow your account quickly. Avoid overtrading. Because gold moves so fast, it's tempting to keep chasing setups. Don't. 2 to 3 high-quality trades per session are enough. Focus on precision, not quantity. 6. Trading strategies that work. Now let's get into the practical part: strategies. Here are 2 proven ones. Strategy 1: breakout trading. Mark strong support and resistance zones. Wait for price to consolidate near these levels. Place buy-sell stop orders just outside the zone. Confirm with RSI or MACD to avoid fakeouts. Always use a stop loss in case of false breaks. This works brilliantly during major news releases like NFP. Strategy 2: trend following with moving averages. Use the 50 EMA and 200 EMA. Only take trades in the direction of the trend. Enter on pullbacks to the moving averages. Exit when price closes strongly against the trend. This strategy is slower but safer. Gold trends hard, and following the trend is often the most profitable approach. 7. The psychology of trading gold. Here's something most traders ignore: psychology. Gold will test your emotions like no other asset. Fear because gold moves fast. Traders panic when price turns red. Greedy after a quick profit, many stay in too long hoping for more, only to see gains vanish. FOMO: seeing a big move, traders chase it, entering late only to get caught in reversals. The solution: have a plan and stick to it. Accept that losses are part of the game. Don't let emotions decide when you enter or exit. Remember, professional gold traders aren't necessarily smarter than you. They're just calmer. 8. Tips from professional gold traders. Always track the news calendar. Gold reacts violently to economic data. Respect round numbers. Levels like 2000 are psychological battle zones. Use smaller leverage. Gold's volatility already gives you big moves. You don't need 17500 leverage to profit. Journal your trades. Write down why you entered, how you felt, and what you learned. Over time, patterns will emerge. Conclusion: so how do you trade gold in Forex trading? It's not about guessing or luck. It's about following a clear process. Understand the fundamentals. Trade at the right sessions and time frames. Use technical analysis tools that work. Manage your risk like a professional. Stick to proven strategies. Master your psychology. Gold is powerful. It rewards the disciplined and punishes the careless. If you approach it with respect, patience, and strategy, you can unlock incredible opportunities. Now, if this video helped you, make sure you hit that like button, subscribe to the channel, and share it with someone who wants to master trading gold. And let me know in the comments, what's your biggest challenge when trading gold? Stay focused, stay disciplined, and I'll see you in the next video.